All right, let's talk about big banks. Usually when you think of them, you think stability, you think predictable. But what if one of them decided to shake things up a bit? Today we're diving deep into the Bank of Nova Scotia, ticker BNS. It's a Canadian banking giant for sure, but it has a really interesting international twist that sets it apart.
And we are going to frame this entire analysis around one big question. And this comes straight from our source material. Can BNS actually deliver a consistent 9% annual return for someone who's in it for the long haul? That's a pretty high bar. So let's see if the numbers and the business model can actually get us there.
Okay, so first things first. Before we even dream about that 9% return, we've got to understand what this company actually does. What is it about the Bank of Nova Scotia that makes it different from all the other big Canadian banks?
And this right here, this is the whole story. BNS isn't just your run-of-the-mill Canadian bank. They've placed a huge bet on Latin America. And that creates this really fascinating mix, right? You get the rock-solid stability of the Canadian banking system, but you also get a shot at much faster growth. And, let's be honest, the higher risk that comes along with emerging markets.
A bold strategy is great, but does it actually create value for investors like us? It's time to pop the hood and dig into the financials to see what they're really telling us.
So, before we get lost in the weeds of spreadsheets, what's the gut check? What does the big picture look like? Do these initial numbers give us a reason to get excited?
Okay, this is where it starts to get really interesting. Our source material uses a couple of different methods to figure out what this stock is actually worth, its intrinsic value. The first, discounted cash flow, or DCF, is basically trying to calculate what all the money the company will ever make is worth in today's dollars. The second, multiple of earnings valuation, or MEV, is a bit simpler. It just compares the price to what the company is earning right now. And look at that, both of them point to a value somewhere between 90 and 100 Canadian dollars, which is pretty close to where it's trading.
And here it is. This is the central problem for any potential BNS investor. Right now, the stock is trading around $97. But to have a realistic shot at hitting that 9% annual return we're aiming for, the analysis says we need to get in at around $80. That is a big gap. So the question becomes, is the market just overvaluing the stock, or is there something else going on here?
To really understand that price gap, we have to go deeper. It's time to look at the real health of the business, the strengths, the weaknesses, and maybe some of the risks that aren't so obvious just from looking at the top-line numbers.
Every great company needs what investors call a competitive moat. It's that special something that protects it from the competition. Think of a castle. In Canada, BNS has a huge moat. It's a massive, trusted brand, and it's almost impossible for a new bank to challenge them. But the moment they step into the international arena, that moat shrinks. There's way more competition, which means they have to fight a lot harder for their profits. And that's the core tension of their entire business.
Looking at profitability, things look pretty strong. An operating margin of 37% is definitely healthy. But the number that really jumps out here is the dividend payout ratio. At 65%, they're sending a big chunk of their profits right back to shareholders. Now, if you're an income investor, you love to see that. But it also means there's less cash left over to reinvest back into the business. And for a bank trying to grow aggressively in Latin America, that retained cash is absolutely critical. And of course, no investment is ever risk-free. The source material points out a few things we really need to keep an eye on. Free cash flow has been trending down, debt is creeping up a bit, and all those international operations make the accounting way more complicated than their peers. So this isn't exactly a simple set-it-and-forget-it kind of bank stock. So we've got a decent picture of the good and the not-so-good. But how do we weigh it all? Let's try to put some actual numbers on these risks and potential rewards. This analysis, looking at strengths, weaknesses, opportunities, and threats, gives us a weighted score of 6.8 out of 10. So what does that really mean? It tells us BNS is a solid company, but it's not a slam dunk. The opportunities for growth are very real and exciting, but they're pretty evenly balanced by the threats that come with operating in less stable economies.
Now let's zoom in on just the risk. Here, we get a score of 7 out of 10. The source material considers this an investment with above-average risk. And it all comes down to that one big thing we keep talking about, the international exposure and the choppy, unpredictable earnings that can come with it. But on the flip side of that risk is opportunity, and the opportunity score is a 7.2 out of 10. This is the whole reason you'd even consider BNS. You're taking on that extra risk because the potential upside, the potential to grow way faster than its Canadian-only peers, is significant. It's the classic risk-reward trade-off right in front of us.
So let's play out a few what-ifs.
What could the future actually hold? In a worst case or a bear scenario where Latin America really struggles, the stock might only be worth $75. But in a best case bull scenario with everything firing on all cylinders, it could be worth as much as $115. The most likely outcome, the base case, is around $95. This huge range of possibilities is a direct result of that bold international strategy.
Okay, we've looked at the business, we've crunched the numbers, we've weighed the risks. Now it is time to put it all together and answer the most important question of all. What is the right price to pay for this stock?
Let's get right back to our original goal. If our target, our non-negotiable, is to make a 9% annual return, what price do we need to pay to make that happen? I absolutely love this table because it makes the decision so incredibly clear. It shows you that your future return is directly linked to the price you pay today. If you'd be happy with a 7% return, hey, you could probably buy the stock right now. But if you are holding out for that 9%, you need the discipline to be patient and wait for the price to drop to $80. Want 10%? You need to be even more disciplined and wait for $72.
And, your investment timeline plays a huge part in this too. If you're only planning to hold the stock for 5 years, you can actually afford to pay a bit more, around $88, and still have a good shot at hitting your 9% target. But if you're like me and you're in it for the long haul, say 16 years, you have to be much stricter with your entry price to really give yourself the best possible odds of success.
Wow, we have been through a lot of data. So, what's the bottom line? Let's take all of this analysis and distill it down to a simple, actionable conclusion.
So, here's the big takeaway. BNS offers something pretty unique, a shot at much higher growth than you're going to get from the other Canadian banks. But that growth potential comes with a price tag, higher risk, and more volatility. At its current market price, there's just not much of a safety net if things go sideways. To make this investment worth it, you really need to buy it at a discount to pay you back for taking on all those extra risks.
And that brings us to the final, crystal clear verdict from our source material. At its current price, this is a hold. If you are an investor dead set on that 9% return, the recommendation is to wait for the price to fall below 80 Canadian dollars. That's the price that gives you the margin of safety you need to make this a potentially great long-term investment.
So that is the story of the Bank of Nova Scotia, a unique mix of Canadian stability and international growth potential. Now I want to hear from you. What companies should we put under the microscope next? Let us know down in the comments.